You've got $100,000 sitting in your account. What you do with it next could be the difference between retiring at 55 or grinding it out until you're 70. Put it into the stock market and let compound interest do the work, or use it as a deposit, leverage into property, and let other people's money build your wealth. This is the great Australian debate, and today we're settling it with real numbers. $100,000 in stocks versus $100,000 in real estate. Which one actually wins? Let's start with stocks because most people underestimate how powerful this option really is. If you dropped $100,000 into an ASX 200 index fund today, history says you'd earn roughly 9 to 10% per year when you include dividends. But here's the part that makes the Australian share market special: franking credits. Because Australian companies have already paid tax on their profits, you get a credit that boosts your after-tax return. The average dividend yield on the ASX 200 right now sits around 3.3%, and a big portion of those dividends come fully franked. When you factor that in, your effective return gets even juicier. So let's run the numbers. $100,000 invested in a diversified ASX index fund, compounding at 9% per year for 10 years, grows to roughly $236,000. Stretch that out to 20 years and you're sitting on about $560,000. And here's the beautiful part. You didn't need a bank to lend you anything. No mortgage applications, no landlord insurance, no tenants calling you at midnight because the hot water system blew up. You just bought the fund and let compound interest do the heavy lifting. There's another advantage people rarely talk about. With stocks, you can start small and add consistently. You could drip feed an extra $500 a month into that same index fund on top of your initial $100,000. Do that for 20 years at 9%, and you're not looking at $560,000 anymore. You're looking at well over $900,000. That kind of dollar cost averaging smooths out the bumps, takes emotion out of the equation, and turns your wealth building into a boring, beautiful machine that runs on autopilot. But here's where things get really interesting. Because property investors have an unfair advantage that stock investors simply don't have easy access to. It's called leverage. And this is where the debate flips completely. With $100,000, you don't buy a $100,000 property. You use it as a deposit and buy something worth $500,000 or even $600,000. The bank lends you the rest. So your $100,000 is now controlling a $500,000 asset. Australian property has historically grown at about 6 to 7% per year on average. That sounds lower than stocks, right? But hold on. That 6 to 7% isn't growing on your $100,000. It's growing on the full $500,000. So a 6% increase in year one adds $30,000 to your net worth, not $6,000. That's a 30% return on your actual cash invested. Let me put this another way. With the national median dwelling value sitting at around $933,000 and gross rental yields sitting between 3.4% in the capitals and 4.2% in the regions, a $500,000 investment property in a solid growth corridor could bring in roughly $18,000 to $21,000 a year in rent. Now, once you subtract mortgage repayments, insurance, council rates, property management fees, and maintenance, your cash flow might be slightly negative. This is what we call negative gearing. And right now in Australia, you can still claim those losses against your taxable income. Though it's worth watching this space because the government is actively looking at winding back negative gearing and cutting the capital gains tax discount from 50% to 33%. Treasury is modelling these changes right now ahead of the May budget, and if they go through, the tax advantages of property investing will shrink significantly. But even with those potential changes, let's crunch the property numbers. A $500,000 property growing at 6% annually is worth roughly $895,000 after 10 years. Subtract your remaining loan balance and you're looking at a net equity position far larger than what stocks would have delivered. Over 20 years, that same property could be worth over $1.6 million. And if you've been collecting rent the entire time, even after expenses, you've built a seriously powerful wealth engine. Now here's something most people completely overlook when they run these comparisons. They forget about the entry costs on property. When you buy a $500,000 investment property, you don't just need the deposit. You're also paying stamp duty, which, depending on the state, could run you anywhere from $15,000 to $22,000. Then there's conveyancing fees, building and pest inspections, loan establishment fees, and potentially lender's mortgage insurance if your deposit is under 20%. All up, those upfront costs can easily eat $25,000 to $30,000 of your $100,000 before you even own the keys. With stocks, your entry cost is basically zero. Most platforms charge little to no brokerage these days. So when you're comparing like for like, you need to account for the fact that property chews through a significant chunk of your capital just to get started. But here's the thing, picking a winner and moving on isn't how real wealth works. Stocks and property have fundamentally different strengths, and if you understand them, you can use both to your advantage. Stocks give you liquidity. You can sell $5,000 worth of shares on a Tuesday morning and have the cash in your account by Thursday. Property gives you forced savings through your mortgage and leveraged growth that's almost impossible to replicate with shares. Stocks give you diversification with a single purchase. One ASX 200 fund and you own a slice of 200 of Australia's biggest companies across banks, miners, retailers, and tech. Property concentrates your risk in one asset, in one location, in one market. But property gives you something stocks never will: control. You choose the property, you renovate it, you increase the rent, you add a granny flat. You can actively force the value up. With an index fund, you're a passenger, a very well-rewarded passenger, but a passenger nonetheless. And let's talk about the current environment because timing matters. The RBA cash rate is sitting at 4.10%. That means borrowing costs are high right now. If you're buying property with a mortgage, you're paying serious interest. Meanwhile, stocks don't care what the interest rate is. Your $100,000 in an index fund just keeps compounding regardless. On the flip side, rising rates often suppress property prices in the short term, which means if you've got cash and the courage, you might be buying real estate at a relative discount before the next growth cycle kicks in. There's also a psychological element that nobody wants to admit but absolutely matters. Most people who invest in property actually stick with it. The mortgage forces you to keep paying. You can't panic sell a house at 2 a.m. because the market dipped. But with stocks, the temptation is always there. One bad headline, and people start selling at the worst possible time. Behavioral finance research tells us that the average investor dramatically underperforms the market they're invested in, not because the investments are bad, but because human emotion gets in the way. Sometimes the best investment isn't the one with the highest theoretical return. It's the one you'll actually hold on to long enough to let it compound. So here's the real answer to the $100,000 question. If you want simplicity, low maintenance, and solid long-term compounding, stocks are incredibly hard to beat. Drop your $100,000 into a diversified index fund, reinvest dividends, enjoy your franking credits, and let time do the work. If you want to accelerate your wealth using other people's money and you're prepared to handle the complexity, the expenses, and the risk of leverage, property can deliver returns that stocks mathematically cannot match on the same starting capital. But the real winners do both. They build a share portfolio for liquidity and compounding, and they use leverage to grow a property portfolio alongside it. That's how generational wealth is actually built in this country. If this video helped you think differently about your money, smash that like button and subscribe to the channel for more straight-talking Aussie finance content. Thanks for watching, and I'll see you in the next one.